everybody. My name is Allison Ostrander, and I am the Director of Risk Tolerance here at Simpler Trading. And in today's video, I want to talk about early exercise and assignment. So let's dive in. Early assignment. What is it? Well, early assignment is where an option seller is assigned an exercise notice before the expiration date of an option contract. It typically occurs with American style options, which can be exercised by the option holder at any time before the expiration date. Early assignment can happen when the option holder believes it is advantageous to exercise the option early, potentially due to significant changes in the underlying asset's price or other market conditions. This often happens on Friday when the trade is deep in the money. It can sometimes happen Thursday going into Friday as well, right? But typically happens the Friday of expiration itself. Early assignment may result in unexpected changes to a trader's positions or strategies. So, to avoid early assignment, our traders often manage their positions by closing or rolling their options before expiration to mitigate the risk. Now, in my experience, early exercise and assignment does not happen very often. I've only ever actually have it happen to me once in my entire trading journey. So oftentimes you can hold it into the Friday expiration. And what happens is as you get closer into the close of market itself, if your account can technically does not have enough margin or capital to actually have that risk of early assignment, typically most brokerage platforms will then force your trade to close out before the close that day, to avoid that risk for your account, because obviously they don't want to have to take on that risk themselves if you can't pay for it with the capital available to you in your trading account at the time. So to avoid assignment, right, our traders use option strategies that protect them, such as spreads and butterflies, i.e., avoiding selling naked calls or puts. And this can really help you out. For example, if you're in a vertical spread and you find yourself going in the money at expiration, and all of a sudden you got early assigned, well, you have a long that is paired with a short. So if it's on the put side, for example, and your short gets exercised, well, then typically because your brokerage platform sees that you're in a spread, they also exercise the long for you to where the two match together. And so that way you don't actually ever end up with shares in your account, for example, because of the two bought to open and the sold to open strikes offsetting one another. We also close out options that are in the money prior to expiration typically. Options expiration quick start guide, right? So let's talk about this a little. So, a buyer of long options has the right to exercise at expiration. On long calls, you have the right to exercise and buy the stock at this strike price, provided it is in the money at expiration. Typically, we sell our long calls to collect value on the option strike itself and how that changed. There is not a possibility that it will be exercised automatically early because you are in control of the long option, right? You have the right, but not the obligation to exercise it. So that really benefits you. However, it will automatically exercise in your account if it is in the money at expiration and you do nothing. You will then be long shares of the stock from this strike price. If it's out of the money at expiration, then it expires worthless and you will not have to worry that it will be automatically exercised. So, for example, with Netflix, if I had bought to open a long call at 410 and it goes into expiration and I hold it through the close, then I will get exercised to have shares at the 410 strike level, meaning I basically bought to open 100 shares of Netflix per one contract at $410. If bought to open the 420 call and it remains out of the money going into this expiration date, then it will end up expiring worthless and I won't have to worry about being automatically exercised. On long puts, I have the right to exercise and sell the stock at this strike price, provided it is in the money at expiration. Typically, we sell our long puts to collect the value on the option itself. There is not a possibility that it will be exercised automatically early because, once again, you are in control of the long option. However, it will automatically exercise in your account if it is in the money at expiration and you do nothing. You will then be long the shares of stock from this strike price. If it is out of the money at expiration, it will expire worthless and you will not have to worry that it will be automatically exercised. Buying long options doesn't come with a risk of assignment. It's possible that you could be automatically exercised on long options if they're in the money at expiration. A seller of short options has given someone else the right to exercise that option, and they can be assigned at expiration. You, on short calls, for example, you have given someone else the right to buy the stock from you by selling this option at a certain price, the strike price, and have the possibility of being assigned either early or if it's in the money at expiration. You will be assigned if you let this expire in the money at expiration. For this reason, we always close the put or call prior to expiration, right? If it is out of the money at expiration, it will expire worthless and you don't have to worry that it will be assigned. Short puts, once again, you have given someone else the right to sell the stock to you by selling this option at a certain price, the strike price. And you have the possibility of being assigned either early or if it's in the money at expiration, forcing you to buy the stock at this strike price. You will be assigned if you let this expire in the money at expiration. If will expire worthless and you don't have to worry about it. So basically, what that means is if it's in the money, right, then you will end up with that assignment risk. If it's out of the money, then it will expire worthless and you don't have to worry about getting assigned. To avoid the risk of assignment in general, we typically close out of any short options prior to expiration. So I know it sounds complex, but the main thing to remember is to close out of your position before expiration if it's in the money. So if it's really far in the money on one side or the other and it's getting to be close to expiration or it's the day of expiration, the closer you get into market close, remember to just close out of your trade, right? Get out of it if you don't want to have that risk of assignment or the risk of being exercised. So, what to do upon assignment? If this ever happens to you, first of all, don't panic. Decide if you want to hold the position or exit it, right? Do you actually want to hold shares of that in your account or do you just want to get out of it? Contact your broker to determine what your options are as they can see into your account, right? They'll have a better idea of the capital you have overall in your account and whether or not your account can sustain being assigned shares. And of course, adjust your position accordingly, right? Always do what you think is best for your account, but don't lead to automatic panic, right? That leads to that emotion, to that dark side of trading. Keep a calm and cool head and then go through the different steps that are available to you and choose which one makes sense best for you and for your account. Thank you so much for joining me. As always, may the trade be with you, my fellow Jedis, and I look forward to talking to you next time. Bye.